Diageo peaked 4 years ago. Since then, the owner of Guinness, Johnnie Walker, and Smirnoff has lost 66% of its value, one of the most sustained destructions of shareholder wealth in the FTSE 100's recent history. The market's verdict was not irrational. Revenue has sat stubbornly near the £20 billion mark for 4 consecutive years. Analysts who forecast growth every year have been wrong every year. The culprits were structural and, on the face of it, durable. GLP-1 weight loss drugs were suppressing appetite for alcohol. A generation of younger consumers, labeled sober curious, was simply drinking less. Gen Z was not replacing the habits of the baby boomers stepping back from the bar. When a company misses growth targets for long enough, the market stops paying a premium for the promise of future earnings. Diageo's price-to-earnings ratio compressed from a 10-year average of 24 down to 18. That is not just a discount. It is a market saying it no longer believes the old story. Against that backdrop, the redundancy figures released this week are not reassuring context. The UK saw its worst year for redundancy warnings since the height of the COVID pandemic in 2025, with over 315,000 jobs flagged for potential redundancy. The first 2 months of 2026 are already running 9% ahead of the same period last year. When the consumer is under pressure, premium spirits are rarely the first line item to survive a household budget review. And Morrisons, one of the companies that puts those bottles on shelves, announced the closure of 100 loss-making convenience stores this week, blaming government policy for cost increases that made profitability impossible. The high street backdrop, in short, is not flattering.
Then came the accident. The king visited Washington. Donald Trump, in a display of transatlantic goodwill, removed all tariffs on Scotch whiskey. For Diageo, whose Johnnie Walker brand competes in the United States, its single largest market, this was an unearned gift. The share price jumped 15% in total across the recovery period. It is worth being precise about what this changes and what it does not. What it changes: the immediate cost structure for Scotch exports into America. Tariffs had been a material drag. Removing them improves the margin outlook for one of Diageo's flagship categories in one of its most important geographies. A strong third-quarter trading update, released around the same time, allowed the company to reiterate full-year guidance. The combination of genuine trading stability and an external tailwind is a legitimate reason for a re-rating. What it does not change: the 4-year revenue plateau, the structural questions around drinking habits, the trajectory of GLP-1 adoption, the preference data on Gen Z consumption. None of these were addressed in the trading update, and none of them disappeared because a tariff was lifted. The company has been here before. In February, the shares rose 15%, then fell back further than they started after the dividend was cut. The market has twice now offered Diageo a recovery window, and twice the underlying pressures have reasserted themselves. The question investors are now asking is whether this time is different, or whether this is the same trade with a different catalyst. The honest answer is that the data does not yet support a definitive verdict either way. The long-term structural concerns, changing consumption patterns, GLP-1, generational habits, are not showing up in the numbers yet, as the company itself noted. But "not yet" is doing a great deal of work in that sentence.
At a price-to-earnings ratio of 18, Diageo is trading at a 25% discount to its own 10-year average of 24. For a company with recognizable global brands, a distribution network that took decades to build, and pricing power that has historically been resilient through economic cycles, that discount is striking. The comparison elsewhere in the market is instructive. Ceres Power, a loss-making fuel cell company listed on the FTSE 250, has risen 260% so far this year. The company is forecast to generate a small profit in 2028, which, on current projections, would put it on a price-to-earnings ratio of around 640. That is the market's appetite for a speculative technology story with an AI data center angle. Against that backdrop, an 18 times earnings multiple for the maker of Guinness looks almost quaint. But the value trap argument is equally coherent. A discounted multiple is only a bargain if earnings are stable or growing. If GLP-1 drugs do begin to structurally suppress alcohol consumption across developed markets, and the evidence so far is inconclusive but not dismissible, then 18 times earnings may not be cheap at all. It may be the market correctly anticipating that the earnings in the ratio are about to shrink. Analysts have predicted Diageo's growth every year through to 2029. They have been wrong consistently. The question is not whether Diageo is cheap relative to history. The question is whether history is the right benchmark for a company navigating a potential secular shift in its end market. The presidential tariff gift has bought Diageo time and credibility. If the next 2 quarterly trading updates show revenue breaking above the £20 billion ceiling that has held for 4 years, then the PE of 18 is genuinely mispriced on the low side, and capital that repositioned early in this recovery will have read the structural story correctly. If revenue stalls again and GLP-1 adoption data from the United States begins to register in consumption figures, the February pattern reasserts, a rally that gave back everything and more. The structural bears have not been defeated. They have simply been asked to wait a little longer, and the price at which they return is the only variable that matters now. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.